If you want to wipe out old federal tax debt, bankruptcy might be an option. The nice thing about a Chapter 7 bankruptcy is it doesn't matter how much debt you owe. On the other hand, there are debt limits with a Chapter 13 bankruptcy. Another nice thing about a Chapter 7 bankruptcy is you could possibly have your debts that qualify wiped out in 90 to 120 days. Well, right now, I'm going to go over what personal federal income taxes can be discharged in a Chapter 7 bankruptcy. I have a separate video for a Chapter 13 bankruptcy. Now, I'm not giving you tax or legal advice. You should consult with both your attorney and your tax advisor so that you can come up with a strategy to try to get as much discharged as possible. I know that a lot of people file for bankruptcy because their wages have been garnished, or because the IRS is demanding payment, or because they are concerned about a tax lien. When you file for bankruptcy, a wage garnishment and any collection efforts will stop. When it comes to a lien, if the IRS processes a notice of federal tax lien before you file for Chapter 7 bankruptcy, you could even lose part or all of your exempt assets that you can normally keep after a bankruptcy. Once your case is closed and your tax debt is discharged, the IRS may not be able to come after you personally for the tax debt, but they can seize or sell the assets that have a lien on it. For example, if there's a federal tax lien and your home isn't sold during your bankruptcy case, the IRS would still have a lien on your house after the bankruptcy case is over. If you don't have enough equity in your home to pay off both the mortgage and the tax lien during your bankruptcy case, more than likely, your home would not be sold during the bankruptcy. If you choose to stay in your home instead of voluntarily selling it during the bankruptcy, the IRS will get paid when you sell or refinance your home. Technically, after a lien is filed, the IRS could take your home and sell it, but they rarely do that. The IRS is willing to wait it out because as you continue to make mortgage payments, you will build equity in your home. The tax lien is automatically attached to the increased equity, which gives the IRS a better chance of collecting the full amount of the tax debt that you owe. If you are afraid that the IRS might record a lien, then you may want to go ahead and file for bankruptcy because the IRS cannot record a lien after you file for bankruptcy. One problem that you might have with entering into a bankruptcy before the IRS places a lien is you would miss out on discharging any tax debt that could be added if you were to wait a little longer. Now let's take a look at what tax years can be discharged. But first, I want to mention that you can only qualify for a Chapter 7 bankruptcy if you meet certain income requirements and if you're not able to make monthly payments toward your debts. The income limitations are based on the state where you live. Only taxes on income or gross receipts can be discharged. To be discharged, the income or gross receipts have to be for tax returns due more than 3 years before your bankruptcy petition date, and the taxes have to be assessed at least 240 days before your bankruptcy petition date. If you requested an offer in compromise or you requested a collection due process appeal, this will add days to the 240-day period. The 3 years is from the date the return is due and not from the date when you file the return. If you requested an extension, the due date would be the extension due date instead of the normal April due date. In most states, you would have to have filed these tax returns more than 2 years before you file for bankruptcy. As you can tell, the timing rules for discharging federal tax debt through bankruptcy are pretty strict. You should always request your tax transcripts from the IRS because the IRS will go by what's on their records. In some states, your federal tax debt will not be discharged for any year that you did not file a tax return. If the IRS prepared a substitute return and you did not assist the IRS in preparing the return and you did not sign the return, the substitute return will count as an unfiled return. If any part of your tax return is considered to be fraudulent or you try to evade or defeat your tax debt, you won't be able to discharge any tax debt associated with that tax return. Only the tax returns filed before your bankruptcy case is filed will be included in your bankruptcy case. If you have tax debt included in your bankruptcy case that cannot be discharged, part or all of this tax debt will be paid through the bankruptcy if you have enough assets to cover the debt. In the year that you file for bankruptcy, if you want to include the tax liability that you have incurred for the year so far, you can elect to file a short tax year. In order to determine the amount of liability that you have incurred for the year so far, you will annualize your taxable income. If you and your spouse file a joint election for a short year, then you must file a joint return for the first part of the short year. You don't have to file a joint return for the second part of the short year unless you want to do so. Your tax year will be closed the day before the date that your bankruptcy case starts, and you will have 2 short tax years, a short tax year before the start date and a tax year that begins on your bankruptcy start date. If you don't make a short tax year election, your tax liability for the tax year that your bankruptcy case begins will not be included in the bankruptcy. If you only have exempt assets, you cannot make a short year election. Although you can't discharge taxes due less than 3 years before your bankruptcy filing date, the benefit of doing a short tax year is having your tax debt that is included in the bankruptcy paid before the debts of your unsecured creditors. What you are trying to do here is cram in as much tax debt as you can so that your assets will pay for your tax debts instead of paying for your unsecured debts. Funds from the bankruptcy will go toward your tax debt first, and your unsecured creditors will get whatever's left over. Actually, it's possible that your unsecured creditors might not get anything at all, but the debts of your unsecured creditors are going to be wiped out anyway. So a short tax year might be a good strategy to use if you have enough in assets to cover your tax debt for the short year before your bankruptcy. If you don't have enough assets to pay off the taxes that were filed less than 3 years ago, or the taxes from the short year before bankruptcy, you will have to pay these taxes yourself after your bankruptcy case is over. Please analyze your tax situation before you elect a short year because it might have a negative impact on your tax situation. For instance, if you have capital losses during the short year before bankruptcy, you may not want to make a short year election so you can use these losses on your future tax returns instead. Okay, so after you file for Chapter 7 bankruptcy, the assets that you had before you filed for bankruptcy will be put into an estate. This estate is totally separate from you and has its own tax ID number, and this estate is taxable. If you file for bankruptcy with your spouse, you and your spouse will have separate bankruptcy estates. The estate is usually controlled by a court-appointed trustee. The trustee will file a tax return for the bankruptcy estate and will decide which assets to sell. You will continue to file your regular income taxes on Form 1040. When it comes to selling your assets, your tax debts that cannot be discharged will have an advantage over your dischargeable non-tax debts. The sales proceeds received by the trustee will be used to pay any tax debts that can't be wiped out before the trustee pays your debts that can be wiped out. This means that you might be able to lower the amount of taxes that you will still owe after your bankruptcy case is over. For example, let's say that you owe $25,000 in tax debt that cannot be discharged, $70,000 in tax debt that can be discharged, and $10,000 in credit cards that can be discharged. We will say that the trustee sells an extra car that you own for $5,000 and pays it toward your non-dischargeable tax debt. So $70,000 in dischargeable tax debt and $10,000 in credit card debt will be wiped out in the bankruptcy, and once your bankruptcy case is closed, you will still owe $20,000 in non-dischargeable tax debt. There's a caveat when it comes to credit cards or other loans that were used to pay federal income taxes. If you used a credit card or borrowed money to pay non-dischargeable taxes, that credit card debt or loan would not be dischargeable in a Chapter 7 bankruptcy. The credit card company or lender would have to submit a request to have the bankruptcy court treat this debt as non-dischargeable. For example, if you file bankruptcy this year, your tax return for last year is not a debt that can be discharged. If you paid your taxes last year using your American Express credit card, American Express can request that you pay that portion of the credit card debt that was used to pay your taxes for last year. Normally, you would be able to have that American Express debt totally wiped out in bankruptcy, but now you have to pay some of the debt. The interesting thing is that you would be able to discharge this credit card debt under a Chapter 13 bankruptcy because a Chapter 13 has different rules. Now, if something goes wrong and your bankruptcy case is dismissed, the bankruptcy estate will just disappear and it will no longer be a separate taxable entity. You will have to file an amended 1040-X federal tax return for each year that your bankruptcy case was active. For your amended returns, you will pick up the income, deductions, and credits that were included on the bankruptcy estate returns. As things go, if you don't meet the income requirements for a Chapter 7 bankruptcy, you might be able to do a Chapter 13 bankruptcy. If you want to know more about Chapter 13, please watch the video on the lower left of your screen. Also, before you file for bankruptcy, you should check into both an installment agreement and an offer in compromise. If you can get an offer in compromise, you will pay less than the amount owed on your federal income tax debt. If you want to know more about an offer in compromise, please watch the video in the upper left of your screen. I hope things get better for you. Take care.